Hooty hoo, all my stock market gamblers. Welcome today. It's Friday, made it to the end of the week, and what a week it was. What do we got going on today in the stock market? Well, it's a little bit flat. It's up a little bit, about 50 points on the Dow, but nothing major. Now, we're down about 2% in the stock market right now, and a lot of people are saying to buy the dip. And buy the dip has always worked, and it always will work, right? Well, maybe not. I think we're going to get another leg down here. Now, why do I think we've got another leg down coming? We're down about 2%. I don't think it's time for the crash just yet, and we're going to talk about that more in a second. I think we are going to get a little pullback, a little correction. Okay, so down about 2%. I think we're going to hit at least be somewhere between 5 and 10% down on this pullback here. Now, I think this because, well, I look at certain things. I look at the VIX. The VIX is relatively low, right around $17. But if you look at the options on the VIX and you go out till December, it'll cost you about $5 to buy a call at the 17 strike price and only about 50 cents to buy a put. This is telling you that professional traders think the VIX is going to go higher. And when the VIX goes higher, the VIX is a fear indicator. As it goes higher, the market comes in. So I do think we're going to get more of a pullback here. I also look at the HYG. The HYG is basically junk bonds. Junk bonds, well, it's coming down. The interest rates are going up on the junk bonds, but the actual junk bonds are starting to come down. And that usually precedes the stock market from coming down. The stock market will follow the junk bonds down. Now, like I say, I'm just expecting pretty much a correction here, nothing major. When you're pumping in $2, $3, $4 trillion at a time into the markets, it's hard to get the crash. But we are going to get the crash, and, well, nobody knows exactly what's going to pop the bubble. Now, there's going to be a pin that pops the bubble, and I want to talk about this. Let's talk about what one of the pins could be. It could be the Evergrande situation in China. Now, there's actually 3 major developers that are basically going belly up in China. Evergrande, Fantasia, Country Garden. They're all in big trouble. And a lot of these have, well, basically what are now junk bonds. Evergrande, let's take Evergrande, for example, about $300 billion in bonds. And they're still making their payments, but they could default any day now. Any day. They're out of cash. They don't have any way to make the payment. And some of these bonds are as high as 10 or 12% interest. They're just not going to be able to do it. It is going to be a default. We're not exactly sure when, but it's coming. Okay. Could that be the pin that, pops the bubble? Maybe it could, but here's something how I know we're getting close to the end. Okay. So what people are doing now is, well, let's talk about this. There's all types of bubbles, right? There's the stock market bubble, the real estate bubble, the bond bubble. Okay, well, what they're doing now is very fascinating. The house prices have gone up. So what they're doing is what's known as a cash out refi. They're refining their houses to take cash out. Okay, and in the second quarter, there were over 1 million of these cash out refis. So the people, they get this cash, right? Let's say they have some equity in their home and they take the cash out. Now that's fine. Okay, if they want to do good stuff with it, pay off some debt or, maybe fix up the house a little bit. But that's not what they're doing. No. What they're doing is they're taking the money out of the house to put into the stock market. Now, this makes sense, right? Because they can borrow the money out of the house at 3%, and the stock market's going up at 30%. 30%, so 3% money, take it out and borrow it, and then put it in the stock market, and you get 30% return. Isn't that smart? Very smart. Now, there was a very prominent financial advisor, a very close friend of mine back in when we had the dot-com boom. And what she was doing was advising her clients to take a second out on their house when the NASDAQ was up at 5,000 at the time, and to put it into the NASDAQ. Okay, now if the NASDAQ went to 10,000, she would have been a genius. But unfortunately, the NASDAQ pulled back and lost about 70% of the value. Now, when the people lost all their money, they still had this second mortgage to pay on their house. It was a terrible financial advice, and unfortunately, she followed her own advice. And she lost her house, she lost her clients, she got sued, and she basically went bankrupt. She lost everything. This was bad advice. It's bad advice now to take money out of your house to go gamble in the stock and crypto markets. But that's what people are doing. They're taking the money out of their house, more debt, and they're going into the markets. And some of them are going into the markets on margin. So they borrow debt, and then they take more debt to put on margins to go buy the stock market. And this is sending the stock market higher. But it's a relative bubble. When the stock market goes down, well, they're still going to have their big loan on their property, and the property will probably get given back to the bank. Okay, so when the one bubble pops, the next bubble pops, the next bubble pops. Okay, these are all bubbles together. Now, we didn't have this back in the dot-com day. The dot-com was a bubble, but real estate wasn't a bubble. Real estate wasn't a bubble until 7 or 8 years later when it finally popped. But right now, we got everything going as a bubble. Okay, so they're using their houses, again, as ATMs, right? They're personal ATMs. And they're pulling billions and billions of dollars out of their ATM. Now, what I want to talk a little bit about is, okay, let's say you pulled your money out of your house and you got that second on there, or you did a refi of the first. Okay, so you got that payment there, and now you go to the stock market, but you don't play stocks. No, you play the derivative market. You play the option market. Do you realize the call options? They're at record highs. They just doubled. The call volume just doubled in the last month. Okay, look at the Tesla calls, and these calls are what's known as a derivative. Okay, so people that buy Tesla stock is one thing, but people that buy the calls, those are derivatives of the stock. Now, as the stock moves, the call's supposed to move, right? But what's happened is that there's so much call volume that it's kind of like the calls are now moving the stock. The tail is wagging the dog, right? Now, this was Great Depression stuff. They had what was known as these bucket shops. They were derivatives of the stock market, and people would go in every day, and it was gambling, and they would gamble in these bucket shops. It wasn't the stock market. It was these little shops that you'd go in and you'd bet on derivatives of the market, and it was gambling. And these bucket shops are actually probably what caused the collapse in the 1930s. It was the bucket shops that brought the stock market down. And today, it's going to be the derivatives again that bring the stock market down. You see, derivatives, now, who makes, okay, let's take a look at Tesla. When you go buy the call on Tesla, who are you buying that from? Well, there's a market maker. There's actually a market maker that sells you the call, okay? You're not necessarily buying it from someone else. You could be, but there's so much volume, they need more calls. So there's a market maker that sells you the call. Now, in order for them to sell you the call, they have to hedge their bet. So they go out and they buy the stock, which actually moves the stock up a little bit higher. Okay, so the derivative is kind of moving the stock up higher. You bought the call. But now when your call expires worthless, they don't need that protection anymore. And they kind of sell the stock that they were hedging with. So the market tends to go down. And this is where you get this big volatility. And I mean, look at Tesla was at $1,200 and now it's at $1,000, a 20% move. Now, of course, that was caused mostly by Elon sending out a text saying he's going to sell 10% of his stock. Now, do you think it was just coincidence that Elon's brother sold millions and millions of dollars of Tesla stock the day before Elon sent out that text? Of course it was. That's not insider trading. That was just coincidence. But we got these derivatives out there in this marketplace. Now, these derivatives can bring down the whole system. I'm telling you, they can. They can. You take something like a Dutch bank. Okay, they have I don't know the exact number, and this is just off the top of my head, but I've read articles on this where they have, 40 or 50 trillion dollars with the T in derivative markets. Now, derivatives can go really bad really fast, and it can bring down a whole collapse of the financial system. Derivatives are, yes, they're a double-edged sword, really. You can get a lot of leverage going up, but the leverage, when you have leverage, the leverage goes down. It's great when it goes up, but when it goes against you, it goes down. That leverage can hurt, and this is what's going to bring the markets down, I believe. Now, I don't know the black swan that's going to come in and pop the bubble. I really don't. It could be Evergrande. It could be the derivative market. It could be a major bank going under, but something's going to crash this market, and I think it's getting closer to the end. You see, the system is getting more and more fragile. The more and more derivatives that are out there in play makes the system more and more fragile. And this system's going to break, and it's going to break hard when it breaks. Now, it might hold out till the end of the year, but I think 2022 is going to be a little bit rough for the market. When the crash happens, it's going to be nasty. Look at right now we're down about 2% in the stock market. And it seems like a little crash, right? Because we dropped 2%. You drop 70, 80, 90%. It's going to rock the world, and it's going to happen. It's going to be the biggest crash of all time, and it will happen. These three bubbles are going to pop, and when they start popping, it is not going to be a pretty world that we live in anymore. But right now, we're down about 2%. A lot of people think it's time to buy the dip. I have a small short position on, and I'm holding off on buying the dip. Wait till it gets down 5 or 10%, then I'll be looking at coming in and buying the dip, because I don't think we're ready for the crash yet. But when the crash comes, it's going to be fast. It's going to be furious. So I'm a stock market gambler. If you like this stuff, give me the thumbs up. If you really like it, punch that subscribe button. Get out there. Have a great weekend, everybody, and we can talk more next week. Bye-bye now.